All right, so today I want to do a kind of dive into how does the monetary system work, and specifically looking at, the US and the US dollar. But, of course, many of these concepts will apply to all central banks and fiat currencies throughout the world. And we'll take a first principles approach. So we'll kind of look at, how does money get created within the banking system? How does the central bank play a role in that? And finally, we'll look at, we'll end with quantitative easing. And with that, then at the very end, we'll kind of go through like some analysis of how does the US dollar work? How does this information that we just learned about central banking kind of play into it? And maybe where are we headed in the future? So to start, a bank, has a balance sheet, and thankfully this is pretty simple. So on one hand, they have their liabilities, and those are simply their deposits, right? So or anytime a customer makes a deposit in the bank, it's a liability because the bank, owes that person the money. And on the other side, they have their assets. So they have their securities, their loans, and their reserves. And reserves are always calculated by basically doing deposits minus the securities minus the loans will usually give you reserves. There's cases where this doesn't hold up, but that's a general rule of thumb. And a pretty important concept that one has to understand about this balance sheet is that there's a reserve ratio. And this is set by the central bank. And so if you have a 10% reserve ratio, that means if you have $1,000 in deposits, you must have $100 in reserves. And I should go back here and explain this. So securities are like US Treasury and bonds, and we'll get into that later. Loans are obviously loans that the bank has created, and reserves is basically just cash on hand, right? Cash that they can just right away give to their depositors. Um, and so, the idea with a reserve ratio is as long as you're, above the reserve ratio, you should be able to handle, the day to day deposits that get withdrawn from the bank. Um, and moving this reserve ratio higher or lower affects how much money can be multiplied, which we'll get into here in a second. So let's take this example where we have Alice who deposits money into Bank A. Bob takes out a loan and gives that money to Jeff, right? And Jeff gives Bob a car in exchange, and then Jeff is going to put that money into the bank. And so if we were to look at a bank's balance sheet, well, what happens is in step one, Alice deposits $1,000 into the bank. So we now have $1,000 in reserves. And in step two, when Bob takes out a loan, what the bank does is it's going to create a new asset on this balance sheet, a $900 loan, which is a future guarantee that Bob will pay back that money plus interest, and they're going to deposit $900 into Bob's account. Now, something that's very very important here: the bank did not actually loan out Alice's money. That's a myth, or just a kind of a technicality. So we think of it usually when we put our money into the bank that our money gets loaned out. The bank does not do that. What it does is it actually creates new money, credit, and puts that money into Bob's bank account, and we've just created 900 new dollars. And so what you can actually think of is when you deposit money in the bank uses, that becomes a reserve, and the bank uses reserve as collateral to create new loans or new money. Um, and so, now we've created 900 new dollars. Um, and now the bank, must have at least $190 kept as reserves. And of course, Bob takes out that $900 and he's going to go give it to Jeff, to which, Jeff is going to go put that money into Bank B. So he puts that $900 into Bank B, which becomes $900 of reserves. And Bank B, now that they have those reserves, right, they can now create loans because they are using the reserves as collateral. And so they're going to create here $810 in loans, deposit that into someone's account. And now we've created 900 plus $810, so $1,710 of new money has been created in the monetary system. And so, what does this mean? Well, money, the way that money is created in our fiat world is through debt. And it's actually a pretty clever system. One important concept to know is that, debt creates demand for money. As long as you live in a society that is functioning, right, you're required to pay back your debts. And so that naturally creates a demand for money beyond just, needing to pay for taxes and food and whatnot. So debt creates demand for money. Um, and, at the same time, the only way to create money in our system is through debt. And so as money works its way through the banking system, right, it will grow and grow and grow, as long as you have, some base amount. So if you start with $1,000, it will eventually be able to grow into $10,000 as, loans get created. But of course, this is the upper bound, and you see that it has diminishing returns. And we'll get later into how does the banking system actually increase its base amount of reserves. So, kind of at this point, I just want to stop and, recap on what we've learned. We've learned that, one, the bank does not actually really loan your money. It instead uses your deposits, which become reserves, as collateral to create new money in the system. Um, Everything is debt based. So, we have to be taking out debt if we want to essentially grow the money system and expand credit and keep the economy going. Um, and then, yeah, I'd say those are kind of just the main concepts with that. And then that money can only multiply so much, right? So there's a base amount, and based on the reserve ratio, you can only grow it so much. So at a reserve ratio of 10%, you can basically 10x whatever the base amount of money is in the system, or the base amount of reserves. And one important thing here to note is that, nowadays with these big mega banks and all of that, usually the money just actually just circulates all within the same bank account. So you can imagine that, every 2 weeks you get paid on Friday, and it's very well, or it's very likely, this is actually in my case, that the company I work for and the bank that I have my my paycheck go to, they're the same bank. So the money just stays within that single bank. And nowadays too, like, Bob actually probably wouldn't take the money out of the bank. He would just do some digital payment online. So money nowadays doesn't really leave the banking system, but the math works the same way, right? Um, you know, the $900 loan gets created, goes into Bob's account, which eventually transfers into Jeff's account, and the bank is just going to make another loan against the existing reserves and keep increasing the supply of money. Now, there's another important aspect to all of this, right, that we haven't talked about, which is, well, I guess what we were talking about before in terms of loans is really debt and, yeah, debt within the public or private sector, right? So as individual citizens, companies, whatnot. But there's another way to increase, money, and that's through the US government or any government engaging in deficit spending. And so if we were to go back here and look at this balance sheet, well, when a bank gets a bunch of money into the banking system, and you put money in as deposits, the bank needs to pay interest um, on your deposit. And oftentimes, like, a bank's not going to be able to find a loan right away. It's a complicated process. There's lots of regulation and lots of rules around it. And so, what do they do instead? Well, they go to the U.S. government and they buy treasury bonds. And these are very often short-term securities, 1 to 3 months, sometimes up to a year. And that puts a security on their balance sheet. And of course, what does the US government go out and do, or any government? Well, it goes out and spends that money, which then circulates back into the banking system. And so it turns out to be like the same math. If you have $1,000 of deposits in a bank, $1,000 of reserves, the bank can go out, give $900 of that to the US government, which creates $900 of new money, right? And so now the bank on this balance sheet has $900 of securities, $100 in reserves, and eventually that $900 will work its way back into the banking system. And the total number of deposits will go up to 1,900. And now we're back at $1,000 in reserves and $900 in securities. And so, with all of this, we got to take a look at loan repayment. So, the thing is here is that when you repay your loan, um, or you repay any of your debt, you are destroying money in the banking, or within the economy, and you are increasing bank reserves. And why is that? Well, when you pay back a loan, you are taking money that's sitting in deposits and as a liability to the bank, and you are giving that money to the bank, um, which in turn destroys that amount of money. So in this case, let's say it destroys $500, and now the bank's total amount of loans goes down, but its reserves go up by 500. And so this total value over here stays the same, but now there is less money in the system because we only have $2,500 in deposits. And actually, in this case, the bank's net worth has just gone up. Right now, the bank has more assets than it does in liabilities. And let's say, in this case, this person who has this $1,500 loan, something bad happens to them and they're no longer able to make their loan payments. Well, this becomes, marked as like a bad loan on the bank's balance sheet. And if that person is eventually never able to pay back that loan, right, they go bankrupt, declare bankruptcy. Now, what has happened is that the bank no longer has this loan, which was going to guarantee that one day it will have enough reserves to basically meet its liabilities. And so the bank has now gone insolvent, and the bank doesn't have enough assets to pay back its liabilities. And this is a real problem. And the worse this side of the equation gets, the more likely the bank is, to go completely insolvent and be able to not pay back its liabilities. So this is kind of what happened during the 2008 financial crisis. You had all these mortgage-backed securities. They all went belly up, and then the banks didn't have enough, assets to pay back its liabilities. They needed to be bailed out, so the Fed came in, and lots of shenanigans happened to keep the banking system going. So, kind of a recap of key ideas again. Ideas. Um, Banks do not loan your money. It creates new money and uses reserves as collateral. Money is multiplied as it moves throughout the banking system. And, loan is a future guarantee that money will be given back to the banks with interest. And paying back loans destroys money and increases reserves. And sorry about misspellings here, dyslexia. But, um, and so this leads to another important part, which is the credit cycle. And it's a bad side effect of having a debt based monetary system. Now, this happens without fiat too, but in fiat, it's particularly bad. So, to grow and expand the money supply, we need people to take out loans, we need people to go into debt. And so this creates this time of kind of expansion, monetary expansion. Money is growing and growing. Balance sheets are getting levered up. Companies are taking out loans. They're making purchases, they're making investments. People are buying homes. And at some point, what's going to happen is, some company is going to fall in hard times. And here's the other kind of weird thing about a debt-based system. Because all money has to be paid back with interest, there's never actually enough money to pay back all the loans, right? And so, once things start going south, it becomes a game of musical chairs. So what we can imagine is a company falls on hard times. Maybe they made some bad investments, didn't keep up with technology. Things always are changing, and they go under, right? So they default on their loans, they lay off tons of employees. Those employees, if they're not able to find jobs quick enough, maybe they can't make their house payments anymore. Um, so, they're going to start to default on their loans and whatnot. And of course, they're also going to cut back consumption, which in turns, means that money is going to move slower throughout the economy. Um, and so suddenly money is moving slower throughout the economy. A bunch of banks, maybe now have an increase in the number of delinquencies that are happening. And so they're going to have to start tightening up, who they give loans to and being more careful. Um, and then this just becomes a feedback loop until what happens is now there's, a huge demand and rush to basically hoard cash. And so what people start doing is they start selling all their assets because they're trying to get cash. And so you have falling asset prices. So uh, the stock market's going to go down. You'll see homes go down in value as everyone sells and scrambles to get dollars to repay their loans. Um, and so this is, a classic credit cycle expansion and then these contractions that are very, very painful. Um, and eventually, as the economy deleverages and, lots of debt and money gets destroyed, you kind of go back into this recovery phase where, margins begin increasing again. Companies start taking out loans, people forget about the bad times, and you get back into an expansion cycle. Okay, so where does the central bank come into all of this? Well, the Fed has, a lot of different tools that it can use, but its primary one is to do this asset swap. And so, banks buy US treasuries, and of course, they're giving the US government new money. And what the Fed can come in and do is they can say, hey, I'm going to take, the securities on your balance sheet, and I'm going to give you a reserve. And so the Fed can actually come in and create more reserves instantly by taking securities out of the banks. And so if you look at a bank's balance sheet, they have their base money supply as a liability, and then they have the assets, which are usually securities, um, loans to the bank, which is just overnight lending to keep banks solvent, and then other assets. And a Fed could actually literally come in here and take dirt from a bank. They could buy dirt and give the bank a reserve as long as the bank owned dirt. It doesn't really matter what the Fed takes. Now, if the Fed was taking dirt, of course, everyone would lose faith in the system. So they take, security. And the good thing about taking securities and stuff that is going to be paid back in the future is the Fed can destroy money that way and take money out of the economy. And just to note that that's a way that we can prevent like banana republic hyperinflation, um, is by having everything um, be done through debt, we can basically have a guaranteed mechanism to get money out of the system. But if we were to look at back in this case of the bank is giving the U.S. government money, and in turn they get a U.S. Treasury, and then the Fed comes in and takes a reserve. What it looks like is the bank has on their balance sheet $1,000 in liabilities, and then they're going to buy $900 of securities, and then the bank literally is going to take those securities, um, give the bank $900 in reserves, and then eventually when that money works its way back into the banking system, now they'll have $1,900 in deposits and $1,900 in reserves. And when the Fed does this, they're increasing reserves in the banking system. And so now banks have more collateral to create larger loans, and they can do it for cheaper. So this is, making capital and the cost of capital cheaper, right? The cost to basically raise and create new money to spend and use for whatever means necessary or whatever you're trying to do. And on the Fed's balance sheet, they're going to go from, in this case, having nothing to having now $900 in, base money supply that they've put out there, and they have $900 in securities. And so For the longest time, the Fed's main way of doing this was through the federal funds rate, where the Fed would set a target for 1 to 3 month treasuries. And they would say, okay, we want, the interest rate on these short term treasuries to be at like 1%. And what they do is they basically just buy US treasuries, um, or they swap US treasuries from the banks and give the banks reserves um, until they get to their target rate. And what they're doing is they're basically taking securities off of the market, putting onto their balance sheet, and artificially lowering the short-term interest rate. And you can see here, after World War II, interest rates were very low. The short-term interest rates were very low, and then we have this kind of long-term rise until the end of the 80s, and now we've had basically the great bust in interest rates all the way down to today, where it basically hovers at 0%. And so, what is quantitative easing? Well, all quantitative easing is the same thing, except the Fed is taking other assets that aren't short-term securities. And so today, like, as a response to the COVID and before that, the financial crisis, they were taking from the banks mortgage-backed securities and swapping that for reserves. They were taking long-term U.S. Treasury bonds and basically just loading the banks up with reserves, and then by taking off and out of the market U.S. mortgage-backed securities and longer term Treasury bonds, they're just driving the yields down on everything. And so they're allowing for cheaper and cheaper credit in all areas of the economy. Um, they're financializing the U.S. debt. So this does have consequences where basically the U.S. government can now create money and not really have to worry about servicing the debt because the Fed is there, basically buying all the Treasury bonds off the market. Now, of course, the problem with all of this is, we're just massively growing the money supply. And so it's kind of a mess. Um, you know, things aren't working. There's a lot of negative side effects with this. And when you look at the US in particular, things will start to make a lot of sense. So we'll go through some charts here. Because the US is the kind of world's reserve currency, it has a special place where, in international trade, like two countries will trade with each other with US dollars. They're not going to use the Zimbabwe currency and trade for like the Colombian dollar, right? They would they're just going to use US dollars, right? Because it's trusted. And not only that, there's the petrodollar system. So if you want to buy oil, you have to be buying it in US dollars. And so just globally, there's a lot of demand for US dollars. And when countries get US dollars, what they did for a long time and still do to this day is they take those US dollars and they actually buy um, US or US bonds and treasuries. And so, here we can see the federal debt held by foreign and international investors. And today it hovers at like 35, you know, here a little bit above 40%. And the reason this is you don't want to just hold US dollars if you're like another country. And so they go out, they buy US treasuries, and they'll even sometimes trade in US treasuries between each other. Because treasuries are basically as good as money. The government, uh, for lack of a better word, can always kind of service its debt because they can always just, you know, deficit spend and increase the money supply because they have a backstop of the banks who will buy their securities, and the Fed can just come in and really mandate it through quantitative easing. Um, and on top of that, there's 12.6 billion and trillion and counting in dollar denominated debt throughout the globe beyond just the US. And I think this number is actually at 13 trillion and counting now. So there's a significant amount of debt globally that needs to be paid back in US dollars. And so this just creates immense demand for US dollars. And with this, what does this mean? Well, it means that the US's biggest export is US dollars. And this is why we run such a massive trade deficit and we can't have manufacturing really in the US. Um, our best asset is our currency. Um, and so we have to, basically give it out into the world to keep the global economy running. And so that's why we have such, a large trade balance deficit. And this creates all kinds of, strange and distorted effects in our economy. And so, the US is the basically financial market of the world. And as we pump out our dollars into the global economy, these other countries take the money and with these US dollars, what they then end up doing is they end up, buying US assets. So they buy, our stock market. Um, so they're buying up shares, in the stock market. And that's one reason like ETFs have been great for the US stock market all over the globe. As we cycle out dollars come cycle back in by other countries and people in those countries buying like the S&P. So this really shows up in terms of the net international investment position of our country, where you know Lynn Alden does a really good description of this. But we own $29 trillion in foreign assets, but foreigners own $42 trillion in U.S. assets. Um, and it just shows this distortion. And what happened in like March of 2020, right, when there was this panic of around the COVID virus, we saw this dramatic drop, right, in the U.S. stock market. Well, that was everyone across the globe trying to get U.S. dollars. And because so much of our stock market is owned by foreigners, in some ways we're almost held hostage by them. But at the same time, they're kind of held hostage by us too, with the U.S. dollar being the reserve currency and having this special status. But they were needed to get dollars, and so they were selling shares, and then it just feeds back into this, uh, you know, big crash that happens overnight. Some other interesting trends is since the 70s, when we went off the gold standard, we haven't had a proper deleveraging, and we keep kicking the can down the road um, when dealing with this expansion and increase in debt. And the reason that is a downturn in the credit cycle is really really painful. You know, asset prices fall and fall and fall. Um, no one can get loans, and there's going to be lots of unemployment. Companies are to go bankrupt, all these things. And so the natural response of us as humans is to kick the can down the road. And we did this by, lowering interest rates to the zero bound. And, now we're engaging in quantitative easing, and we're combining it with massive, US deficit spending and doing programs like, unemployment benefits to keep basically the entire system moving with US dollars so we don't have this downturn in the credit cycle. Well, this has really big unintended consequences. And one of them is when we create cheap capital. The fact is, for most Americans, when they get more money or they have access to more money, um, they just go out and buy assets with that. And so a lot of this money just gets funneled back into the financial system. And, one way to see this is to see that, basically after like 1996, the velocity money has just tanked. So that just means money is moving slower throughout the economy. And one reason for that is, it's just kind of going into the financial system. People are just buying assets. Um, and so what you have is you have all this asset inflation that is happening. And this is creating this massive level of wealth inequality. So, what you can probably think about in the future is that we're going to have high levels of asset inflation. And, until this monetary regime, until things break, as we keep expanding the amount of credit in the system or the amount of money, asset prices are just going to go higher and higher. Consumer goods inflation, we've been able to avoid that for a long time. And the reason is there's a lot of deflationary pressures that we've had in the global economy to keep that low. So you can think about the advancements in technology, especially the advancements in terms of the digital revolution. So supply chain optimizations, massive amounts of globalization, which opened up all kinds of cheap labor, has really just prevented consumer goods inflation. But that might be ending now. We don't quite know, but of course, the inflation numbers are quite hot. So if this persists, we'll probably have this systemic issue with consumer goods inflation. And what's the Fed going to do? If they raise interest rates, the economy is going to choke up and vomit. We're so heavily indebted globally. Um, there is kind of this question of, we might be going down this path of serfdom, and kind of going back to what life was in the feudal ages, where we don't get to own much because everything has become so expensive. And, instead we just rent and kind of just pay like monthly subscriptions. Uh, it sounds like a horrible path to go down, but, some people have been peddling it. The question is how much juice does the Fed have left? Of course, in my eyes, I always think, can we off ramp from fiat to crypto? And really, I think maybe the more important thing is I think in the future, as we rebuild our institutions, because they are crumbling and falling apart, we need trust to be the foundation. And no more of this like donkey dick in the ass um, type shit. We need trust as the foundation of our institutions. We need a monetary system that cannot be manipulated, that enforces policy, because the reality is as humans we're very flawed. Who the hell wants to live through a contraction in the credit market? No one. No one does. And so of course we keep kicking the can down the road. But it has created so many issues now in our society, huge levels of wealth inequality, lots of uh, instability. And I guess I'll just end this on a note that, people that are really good to listen to and can explain these concepts really well, like Lynn Alden's a great person. Um, so I'll throw a link down to some of her work in the description. And hopefully, hopefully this has been somewhat insightful and helpful.